As an individual, you can't claim mortgage interest as a relief, but as a limited company, you can actually claim it as a legitimate expense. Corporation tax is set to go down over the next 3 years, so there's definitely a benefit to going down that road. Be careful though, because you could be open to capital gains tax and other things. I definitely advise talking to an accountant. So, a beneficial interest company trust is one option that's open to landlords. It is much more complex, so I'd always advise taking good financial advice on this. It can be very expensive. Essentially, it just involves moving the beneficial interest of the property into a company structure, which then means you can operate your portfolio like you would a limited company. This would be an approach if you're looking to cut costs to absorb the kind of increased expense that you're experiencing here. Interest rates are historically low at the moment, so there's some really good deals out there. If you can shave £30–40 a month off of your mortgage payments, it could help to absorb the extra cost. This is dependent on how you've structured your business in the first place. If, for example, that you own properties with family members or your spouse, what you could look at doing is look at each other's tax codes in terms of are you a high rate payer and your partner's not. If that is the case, then if you redistribute the property income, ultimately you can lower your tax bill. Pay off your mortgage. I know that that's probably a luxury for many landlords, but if you do have the spare capital lying around, obviously this whole exchanges that we're discussing today are about the impact of mortgage interest. If you have no mortgage, potentially you have no issue. So this probably isn't for most, but it's certainly an option, and it's about lowering your tax bill ultimately. And I think for those landlords that are teetering on the edge of higher rate tax, one of the options is to gift income to family members or the individuals or organisations, which should keep you within your current tax bracket. To make more pension contributions, which will be deducted from your income, and create the room for your property income without you being overly penalised for it. So not going to be popular with your tenants, but one of the options is to increase rent. But ultimately, if you need to drive income into your business, you will have to increase rent, and that will ultimately pay your additional tax. Identify your worst performers, perhaps identify those that you've got the most capital in, sell those properties off, take that income, and then reduce the amount of lending that you have on the rest of the portfolio. One of the things you could start looking at is investing in commercial properties. You could be looking at buildings with shops and flats above them, which kind of splits your risk. You would then lease the commercial premise and then let your flat above. You certainly don't just need to restrict yourself to investing into residential property. It's a bit of a utopia, obviously, and I'm sure everyone would like to say that that's the strategy they follow. But ultimately, things like HMOs, commercial properties, anything that really has a high, stable yield will ultimately protect your property business.